Hello everyone, here menna abdelhamid, teacher assistant at Faculty of Commerce English section Actuarial Science. Today we will take revision on Business Finance 2. The revision will cover Chapter 11, Group Accounts and Insurance Company Accounts, Chapter 12, Interpretation of Accounts, and Chapter 3, Limitations of Accounts. Let's start. First question, choose the appropriate answer. Question number 1. In times of inflation, a company that pays out more interest than it receives, profits will tend to be: first choice, overstated in times of high inflation, understated in times of high inflation, the same as in average years. Number D, the same as in recession times. The answer here is B. So, in times of inflation, a company that pays out more interest than it receives, the profits will tend to be understated in times of high inflation. Second question. In creative accounting, few firms may deliberately set out to mislead by choosing the accounting policies. The choices that we have: number A, that will maximize their asset value; number B, that will maximize reported profits; number C, that will minimize their reported profits; number D, that will minimize their assets value. The answer here is B. So, in creative accounting, few firms may deliberately set out to mislead by choosing the account policies, and that will maximize their reported profits. Question number 3. It is the process of totaling the items in the income statement and statement of financial position of two related companies. This process is aggregation process, merging process, conciliation process, consolidation process. The answer here is D. So, the consolidation process, it is the process of totaling the item in the income statement and the statement of financial position of two related companies. Question number 5. Internal balances in the statement of the individual group members arising from relation within the group must be: first choice, reconciled while consolidating the financial statement, cancelled while consolidating the financial statement; number C, retained independently while consolidating the financial statement; number D, aggregated together while consolidating the financial statement. The answer here is B, as in internal balances in the statement of the individual group members arising from relationship within the group must be cancelled while consolidating the financial statement. Question 5. The significance of accounting policies is that they provide a consistent framework for periodic reporting of the results and the financial position of a business, which is the first choice. Second choice, they provide accurate accounting figures where no other yardstick is available. Choice number C, they provide unified calculating methods that should be applied consistently. Choice number D, all of the above. So, the answer here is A. The significance of the accounting policies is that they provide a consistent framework for periodic reporting of the results and the financial position of a business. Next question. Question number 6 refers to the value of the share capital and the reserves provided by the subsidiary's minority shareholder. First, non-controlling interest. Second choice, equity capital. Third choice, internal balances. Fourth choice, none of the above. The answer here is A. So, the non-controlling interest refers to the value of the share capital and the reserves that provided by the subsidiary's minority shareholders. The next question. Question number 7. If company A holds 10,000 shares representing voting rights out of 50,000 shares issued by company B, then company B should be first choice holding company, second choice a subsidiary company, third choice an associate company, fourth choice an insurance company. The result here is number C. So, in case of the company A holds 10,000 shares and they are representing a voting rights out of 50,000 shares that was issued by company B, then company B will be an associate company. Question number 8. A company XYZ has 200,000 from them to a £2 ordinary share in issue. The current market price is £4.2. The company attained 350,000 revenue during the year. يبقى the total operating and administrative expenses were 200,000 and the taxes 880,000. Then the basic earning ratio ERS and the BE ratio to this company will be. The answer here is C. So ERS will be 0.7 and the BE ratio will be 6. Next question. Which of the following best describes the purpose of the consolidation process? First choice, to establish the ability of business to pay its liability. Second choice, to present the holding company's share in the income results and the assets and liabilities separately. Third choice, to show how much cash is available at the end of the accounting period. Fourth choice and the last choice, to present the statement as if the group was a single economic unit. The answer here is D. So, the best description for the purpose of the consolidation process is to represent the statement as if the group was a single economic unit. Next question, question number 10. Which of the following would not explain why the BE ratio of a particular company may stand above the average BE ratio of the other company? So our question here, which of the following would not explain why the BE ratio, of a particular company may stand above the average BE ratio of the other company? First choice, the company's shares are overvalued. Second choice, that earnings are perceived to be relatively risky. Third choice, historical earnings are unusually low. Fourth choice, that potential earning growth is very high. So the answer here is B, as B would lead to a low price and hence a low price earning ratio. So the earnings are perceived to be relatively risky. This statement will not explain why the PE price earning ratio of a particular company may stand above the average price earning ratio of another company. Before we move on, we need to go back to question number 8. In this question, we need to mention the rule and solve we need also to know from which we get the answer C. A company XYZ has 200,000 and for each share the ordinary his price is £2 in issue. The current market price is 4.2. So the current price or the market price of the ordinary share would be 4.2, and the total amount that the company XYZ have is equal to 200,000 for each share £2. So the number of shares that it have, and to get it we have to divide it 200,000 by 2 and then get number of shares. So the number of shares here for the company XYZ is 100,000. And then he said that the company attained 350,000 revenue during the year, and their also total operating and administrative expenses were 200,000 and 80,000. Then the basic earning per share and the price earning ratio to this company will be. Before we solve this question, we need to know the equation of earning per share. As we know that the earning per share equal earning on the ordinary activity divided by the number of issued ordinary shares. And to get the earning on ordinary activities, we have to subtract from the revenue, which is 350,000 revenue. Subtract from this amount the operation and the administrative expenses, which is 200,000 and 80,000. So we get that the total earning on ordinary activities is 70,000. Divided by this the number of issued ordinary shares. And to get the number of ordinary shares, we divided 200,000 divided by 2, so we get the number of shares is 100,000. So get back to the earning per share. So the earning per share will be 70,000 divided by 100,000. So the earning per share will be 0.7. And what about the price earning ratio? Also we need to know that the price earning ratio is the market price of an ordinary share divided by the earning per share. We already got the earning per share from the first require, which is 0.7. Now we need to get the market price of an ordinary share. The market price of ordinary share, it is given in the question, which is 4.2 So we need to divide it 4.2 over 0.7. We get that the price earning ratio equal 6. So here the answer is C, 0.7 and 6. Now we continue our questions. The next two questions refer to BRB Ltd. The following details were extracted from the company's accounting records. In the question, he gave the following data. First, pre-tax profit. Second, tax paid. Third, depreciation, inventories held at the beginning and at the end, 20% loan stock, revenue, share capital, and reserves, non-current assets, and the value of each item. Of this. So we need to now check the next slide to get the question. BRB's return on capital employed was, first choice that we have 20%, 0.68%. Second choice 12.95%. Third choice 13.36%. Fourth choice 13.84%. The answer here is C, but we need to know from which we get this answer. Answer is C, as return on capital employed is profit before tax and interest divided by long-term debt and equity, or profit before tax divided by equity. And we have already the profit before tax, but we need to find the figure for profit before tax and interest. We need to add the loan stock interest back onto on the pre-tax profit. Then the calculation will be 75,000, which is we get from the question, and refer back, which is represent profit before tax. This figure, pre-tax profit, which is before tax profit, is 75,000. Then 15,000 multiplied by 0.12, which is the interest that exists on the loan stock, and this also get from the given data, which is here 12% on the loan stock, and the loan stock itself is equal 15,000. Therefore, the profit before tax and interest will be 75,000 plus 15,000 multiplied by 0.12 over long-term debt and equity. The long-term debt and equity we also get from the example, from the figures that given. We have here 15, which is here, and 425,000. Then the total amount I have for the return on capital employed is 13.36%. The other definition of return on capital employed, profit before tax, equity, is not offered as an option. Okay, next question. Relative to its revenue, BRB's average inventory turnover period was, first choice 149 days, second choice 154 days, third choice 157 days, fourth choice 160 days. The answer here is C, which is the number of days for turnover is 175 days. But we need to know from where we get this answer. As an average inventories equal 0.5 multiplied by 42.1 plus 46.5, therefore we have 0.5 multiplied by the addition of two numbers, which is 42.1 plus 46.5. So we have that in the average inventories equal 44.3, but we need to know from where we get 42.1 and 46.5. As when we refer back to the figures that given in the example or question, we get that the beginning inventory, which is at the year, is 42,100, and the inventories that held at the end of the year equal 46.5 thousand. So this figure represents the beginning inventories that held at the beginning, and this amount represents the inventories that held at the ending of the period. And to get the average of them, we multiplied them after adding them, we multiplied by 0.5. So the average inventory turnover period using revenue as denominator, we get the average inventories divided by revenue multiplied by 365. So the answer will be 44.3 divided by 103.25 multiplied by 365. Also, we need to know that in 103.25, the number of revenue, it's already also given in the question, as we see now. Revenue equal 250. Okay, so after calculating these amounts, we get that the average inventory turnover period using revenue will be 157 days. Let's start. Let's contain question number 13. Which of the following is not a category in the Global Reporting Initiative GRI International Standards on Sustainability Reporting? Economic, social, environmental, governance. The answer here is D. So the governance is not a category, is not categorized in the Global Reporting Initiative GRI International Standards on Sustainability Reporting. Now we go to short answers to the following to short essay questions. But in the exam, it will be all the or most of the exam will be bubble sheet, multiple choice. The exam will be as you agreed with the doctor. Now we take the first question. Explain the differences between associate and subsidiary companies, and illustrate how the accounting treatment of their account is different. Answer. First, in this question, he need to know the difference between associate and subsidiary companies, and illustrate how the accounting treatment of their account is different. Regarding first the associated companies, the associated undertaking, an associated undertaking is one which is not subsidiary, but which is subject to a significant influence by the parent. A significant influence would normally arise if the parent owned between 20% and 50% of the associate's voting rights. Second point, that the consolidated statement of profit or loss and the statement of financial position of the group include single line entries showing the parent company's share of the associate income, assets and liabilities. So first I mentioned what is mean by associated company. Second, I explain how the accounting treatment of their account of the associated company accounts. Second, subsidiaries companies. Subsidiary company. A subsidiary is a company controlled by a parent or holding company. This control may be through holding a majority of voting rights, or by being able to appoint or remove directors holding a majority of voting rights at board meeting. Second, consolidated accounts must be produced. This basically involves adding up the item in the statement of profit and loss and the statement of financial position, presenting the statements as if the group is a single unit. Any interrelationship between members of the group are cancelled. So in this question, first we define an associated company, and we mentioned that an associated companies is not a subsidiary, which is subject to significant influence by parent, and this significant influence would normally arise if the parent owned between 20 to 50% of the associated voting rights. This first point we talk about in the associated company. Second, we mentioned how we treat the accounting treatment of their account. We mentioned that the consolidated statement of the profit or loss and the statement of financial position of the group include single line entry show the parent company's share of the associate income, asset and liability. Just single line entry show parent company share from the associate income and assets and liabilities. Second point we talk about for the subsidiary companies. First we mentioned what is subsidiary company, and we mentioned that in the subsidiary is a company controlled by parent or holding company, and this control may be through holding majority of voting rights or by being able to appoint or remove a directors holding a majority of voting rights at board meeting. Second, we mentioned how we treat the accounting treatment. We mentioned that in consolidated accounts must be produced, and this basically involves adding up the items in the statement of profit and loss and the statement of financial position, and presenting the statement as if the group is a single unit, and any interrelationship between members of group will be cancelled. So this first question in the short answers. Second questions, discuss the limitation of using asset cover ratio in evaluating the borrowing ability of the company. The answer here, the main limitation of asset cover is that the current value shown in the statement of financial position for assets might not reflect their realizable market value if the company is wound up. The going concern concept means that there is no particular need to carry assets at their market values. Second point for limitation, that the minimum of 2x cover gives a safety margin, but an arbitrary one, Also, like interest cover, capital cover doesn't take account of the term of the loan stock. Third limitation, that an investor is likely to modify the 2x rule of sum depending upon the likely realizable value of the assets. The term of loan stock being analyzed and adequacy of the interest cover. So, regarding the limitation of using asset cover ratio in evaluating the borrowing ability is restricted in three limitations. First, that in the current value shown in the statement of financial position for asset will be or might be not reflect the realizable market value if the company is wound up. Second, in the minimum of 2x rule cover will gives a safety margin, but it will be arbitrary one. Third limitation, that investor is likely to modify 2x rule of sum to be depending on the likely realizable value of the assets. So this will be the limitations of using asset cover ratio in evaluating the borrowing ability of the company. Next question. Explain the main weakness of historical cost accounts in times of high inflation. Answer here. The main weakness of historical cost accounts in times of high inflation are: the cost of sales is underestimated and therefore profit is overstated. So the main weakness of historical cost accounts in times of high inflation, first one, the cost of sale is underestimated. If the cost of sales is underestimated, the profit will be overstated. If, for example, an item is purchased for 10 and sold for 15, the company will record a profit of 5, which is logic, which is the difference between the sold amount and the purchased amount, which is 15 minus 10 give us 5 profit. If however the cost of replacing that item of inventory has increased to 12, then the real profit on the transaction is only 3, not 5. Third main weakness of historical cost accounting in times of high inflation. If depreciation is calculating using the historical cost of assets, the depreciation charge will be inadequate and thus again a profit will be overstated. So the first three main weakness: first, in that when the cost of sales is underestimated, the profit will be overstated. Second, if we mentioned it by example, if an item is purchased for £10 and sold for 15, so the company will record by logic 5 as a profit, £5 as a profit, which is the difference between the sold and purchased amount. However, the cost of replacing that item of inventory has increased from 10 to 12. So in this case, the real profit on transaction is only 3, not £5. Third main weakness of historical costs, that if depreciation be calculated by using the historical cost of assets, so the depreciation charge will be insufficient or will be inadequate. So the profit also will be overstated. So we need to take care from calculating depreciation by using historical costs. Fourth main weakness: a company that pays out more interest than it receives, will find that its profit will tend to be understated in times of high inflation, because interest rate tend to be linked to the level of inflation. So when I pay, as a company pays more interest, while what actual I received is less than what I pay, so the profits will be tend to be understated in times of high inflation, as the interest rate tend to be linked to the level of inflation. Okay, last main weakness, that the accounting figures are not comparable between years. So in this case, a profits with assets value might increase in money terms, but it is not clear how much of the increase is a real increase and how much is simply due to inflation. So if accounting figures I will be not able to compare between the years, in this case the profit will asset value may increase in money terms, but it will not clear how much is the increase is a real increase. Is this increase is real or just as the example that we mentioned in the second point? In the example we mentioned that the recorded profit is 5, while the real profit is 3. So in this case I have increase in the assets value and profit, but I'm not sure or I'm not know how I'm not know what is the amount of the real increase, and how much is simply due to the inflation. So I will in this case I will not be able to decide how much the amount in the increase is real increase and how much is due to the inflation. Okay, so there is 5 main weakness of historical cost accounts in times of inflation. Second question. Question number 4 in short answers. Explain why the profit margin ratio and the return on capital employed ratio might be misleading or meaningless as far as shareholders are concerned. Answer here. First, the profit margin ratio may be misleading or meaningless in case for banks or insurance companies where the idea of profit is not clear-cut. Second, for business with large contracts that spread over several years, for example, construction. So the profit margin ratio may be misleading or meaningless. First, in case the idea of profit is not clear-cut, and this will be for banks or insurance companies. Second, the profit margin ratio will be misleading or meaningless in case that spread over several years. For business with large contracts that spread over several years, and for example for this business is construction. Second, ratio for return on capital employed may be misleading or meaningless in case where the capital employed is low or not a major factor of production. Second, where profits are volatile, 1 year's result shouldn't be used. Third, where the entries in the statement of financial position don't produce a realistic value of the actual capital being used. For example, when asset value are out of date or the capital has been raised during the year. So the ratio for return on capital employed may be misleading or meaningless where the capital employed is low or not a major factor of production. Second, where profits are volatile, 1 year's result should not be used. Third, where the entries in the statement of financial position don't produce a realistic value of the actual capital being used. For example, when asset values are out of date or the capital has been raised during the year. Next question. In this question, we will have the following information for company A and company X. For example, you have been given following information from the books of company APC and company XYZ, respectively, and the table show items extracted from the balance sheet and the income statement. The income statement items that we have: sales 300,000 for company ABC and 600,000 for company XYZ, and earning before tax and interest 100,000 for company ABC and 180,000 for company XYZ, and tax rate equal 24,000 for company ABC and 48 for company XYZ. So for the income statement we get sales amount, earnings before tax and interest, and tax rate for each company. Second, balance sheet items. First, we get current assets and fixed assets. Current assets equal 350,000 for a company ABC, and the fixed assets 100,000 for company APC, and for company XYZ the current assets equal 460,000 and fixed assets by 100,000 too, and the current liabilities equal 50,000 for company ABC and 500,000 for company XYZ, and in intangibles for 25,000 for company ABC and 30,000 for company XYZ. And then the share capital, where the price per share is 10 per share, equal 250,000 for company ABC and 250,000 for company XYZ, and long-term loans 200,000 for company ABC and 200,000 for company XYZ, and the interest rate on long-term loans for company ABC 0.1 and for company XYZ 0.1. And the last item we give in balance sheet item, inventory 50,000 for company ABC and 160,000 for company XYZ. So from balance sheet we get current assets, current liabilities, intangibles, share capital, long-term loans, interest rate on long-term loans, inventory. And for income statement we get sales, earnings before tax and interest, and tax rate. Now we showed what is the question in this example or questions. First, calculate the asset cover ratio for both companies and demonstrate what these ratios imply. So in this question he requests from me 4 or 3 requirement. First, calculate the asset cover ratio for both companies, once for company APC and second for company XYZ. Third, required item that I demonstrate what this ratio imply for me and apply this by the existing result that I have. First, I am written the rule. The rule for the asset cover ratio is total assets minus current liabilities minus intangible assets over total loan capital. Okay, that is the rule of asset cover ratio. Total assets minus current liabilities minus intangible assets over total loan capital. For company ABC, I need to calculate first total assets, as it is not given for me the total assets, but what he gave for me? He gave for me current assets, fixed assets, intangibles. The sum of these three items will give me the total assets. So regarding the total assets, I added 350,000 plus 100,000 plus 25,000 as I make here. So the total assets will be 350,000 plus 100,000 for the fixed asset and 350 this for the current and the 100 for fixed plus 25,000 for the intangibles. Then I subtract from this amount the current liabilities. For the company ABC, the current liabilities equal here 50,000. So I am replace the current liabilities by 50,000. Then I subtract the intangible assets, which is by 25,000, and after adding and subtracting this amount, I'm divided by the total loan capital, which is 200,000, and this also mentioned here 200,000. So the numerator will be 400,000, and this get from 350 plus 100 plus 25 minus 50 minus 25, I will get 400,000 divided by 200,000. So the asset cover ratio for company ABC will be 2x. Now I will make this also for company XYZ. First, I need to calculate total assets, and from the question, this question, I get that in the total assets. Total assets here is the summation of fixed assets, current assets, intangibles. So I need to get these three numbers. First, current assets, which is 460,000, and the fixed asset, which is by 100,000, and intangibles by 30,000. So as a whole, as I'm written here, first the current assets, which is by 460,000 plus 100,000, which is the fixed assets, plus 30,000, which is the intangibles. So by this we calculated the total assets. Then we will subtract the current liability, and which is already given in the question, and subtract the intangible assets. We get that the current liabilities equal 500,000 and the intangible equal 30,000 as mentioned in question here. Current liabilities equal 500,000 and the intangibles equal 30,000, and then divided this by the total loan capital, which is here 2 is equal to 200,000 as mentioned here, 200,000. Then we get that the asset cover ratio for company XYZ equal 60,000 divided by 100,000, which is equal 0.3x. So after calculating the asset cover ratio for both company, for each company ABC and company XYZ, we find that the asset cover ratio for company ABC equal 2x, while company XYZ equal 0.3x. This means that he requested from us to calculate the asset cover ratio and then demonstrate what these ratios imply. So our comment, this means that if the company were wound up, the first 50% of the company ABC assets would go towards covering the company's liability to the holders of the long-term loans, or in other words, that the net assets for company ABC is 2 times its loan capital. And also this indicates that company ABC has low financial risk compared to company XYZ, which net assets cover only 30% of its loan. Is this clear? Why company ABC will has low financial risk than company XYZ? As company ABC will have the ability to cover 50% of the loan 50% of the company assets, while company XYZ will have will cover the net assets only by 30%. So company ABC will have 50% of its assets to cover the company's liability or long-term loans, while company XYZ will have only 30% of its net assets to cover its loans or its long-term loans. So by this mean that company ABC will have low financial risk compared to company XYZ. Okay. Second question under question number 3. Calculate the dividend cover and payout ratio for each company. You have been given this extra information that the company ABC will distribute 1.5 per share and company XYZ will distribute 2 per share. Okay. As we do in the previous question, first we need to write the rule and define each item in the rule. Here we need to calculate 2 items. First, dividend cover, second, payout ratio. For dividend cover, which is equal earning per share and dividend per share. Okay, type. Earning per share, we need to calculate it as it's not given in the given data. So I first need to calculate the earning per share. And regarding dividend per share, I'm already given in the question. I have here that the dividend per share will be 1.5 per share for company ABC shares and 2 per share for company XYZ. So I need this given, I need to calculate the earning per share. So I calculate first the earning per share. The earning per share what we mean about earning per share هو earning before interest and taxes subtracted from it interest and taxes and divided by number of shares. So I need to get an earning before interest and tax, and it will be already exist in the question, and the interest I calculated, and taxes it's already given, and I need to calculate it will be given a number of shares. Here sorry, earning before tax and interest for company ABC equal 100,000. So I'm get first item 100,000. interest I have here interest on long-term loan 0.1. okay, from which loan long-term loan here by how much? 200,000. So I multiplied 0.1 multiplied by 200,000. Taxes equal 20. Here tax rate equal 24,000. So I'm get here earning before interest and tax for company ABC, which is 100,000. interest I calculated by calculating the interest rate في loan amount, which is 200,000 multiplied by 0.1, which is 10%. taxes given equal 24,000. طب number of shares, it is not given directly the number of shares here, but it given that in share capital equal 250,000 and each share value 10. So I divided 250,000 divided by 10, I get the number of shares, which is 25,000 as I'm written here. So the earning per share for company ABC will be 100 minus 0.1 multiplied by 200,000, subtracted from them 24,000, and all of that divided by 25,000, and get that earning per share here for company ABC equal 2.24. okay, then I am already to calculate dividend cover. I am already just replace the earning per share by 2.24 and divided a dividend per share 1.5 as mentioned in the question in the given. So the dividend cover for company ABC will be 1.49x. okay, and we will do this too for company XYZ. I need to calculate the earning before interest and tax if it's not given, but here is given, which is 100,000, and the interest 0.1 multiplied by 200,000, and taxes 48,000. I need to show from these amounts. Here earning before tax and interest for company XYZ 100,000 as I'm right, and tax rate equal for 48,000 also as I'm right, and a long-term loan equal 100,000 and the interest rate 0.1. So double check 100,000 minus 0.1 multiplied by 200,000 minus 48,000 and divided by 25,000. And also here we get the number of shares by here divided the share capital over the share amount. 250,000 divided by 10, so I'm get 25,000. So the earning per cover here for company XYZ will be 4.48. And I'm now ready to calculate dividend cover for company XYZ equal earning per share, which is 4.48 divided by 2, which is dividend per share, which is given in the question. So the dividend cover for company XYZ equal 2.24x. okay, so I'm calculated dividend cover for company ABC and company XYZ. Now the payout ratio. as we know that payout ratio is the inverse of dividend cover, which is 1 over dividend cover. So the payout ratio is 1 over dividend cover, or dividend per share over earning per share. So as I'm already calculated the dividend cover, it will be easily to calculate the payout ratio. So here for company ABC, the payout ratio equal 1 over dividend cover, which is equal 1.49. So the payout ratio equal 1 over 1.49. So the payout ratio for company ABC equal 0.67x. While the dividend payout ratio for company XYZ equal 1 over dividend cover for company XYZ, which is equal 2.24. So the payout ratio for company XYZ equal 0.45x. Okay. And now next question. Last question in our revision. Explain why earning before interest and tax is not accurate measure of profitability. Since the answer here is, since the amount charged are based on subjective analysis and may therefore be seen as discretionary, they prefer to focus on earning before interest, taxes, and depreciation and amortization, which is EBITDA. This is often referred to as cash flow from operations. So why the earning before interest and tax is not accurate measure of profitability, as it subject is the amounts will be based on subjective analysis, and it's not logic to based on these amounts. So they prefer to focus on the earning before interest, taxation, depreciation, and amortization, which is we refer to as the cash flow from operations. So by this this is the final question in our revision. But before ending, I need to summarize chapter 12, which is interpretation of accounts. And this chapter we need to know interpret the accounts of a company or a group of companies, and discuss the limitation of such interpretation. Also, second point we need to keen on, which is calculate and explain priority percentage and clearing. Third, calculate and explain an interest cover and asset cover for loan capital. Third, describe the possible effects of interest rate movement on a highly geared company. Third, calculate and explain the price earning ratio as we solve here, dividend yield, dividend cover, and earning before interest and taxes, and with depreciation and amortization that we talk about just now. Fifth, explain net earning per share. Sixth, calculate and explain the accounting ratios, which is indicate the profitability, the efficiency for the company. This for regarding chapter 12. It's very important to know these calculations and how to interrupt each amount that resulted for us, and link this amount and how it affects the company or the profitability or efficiency of the company, and it will be low or high financial financial it has low or high financial risk. This for chapter 12. Also regarding chapter 13, which is limitations of accounts. In this chapter we concern on interrupt the accounts of a company or a group of companies, and discuss the limitation of such interpretation. Second, discuss the shortcoming of historical cost accounting. Discuss the limitation in the interpretation of the company accounts. Discuss the ways that reported figures can be manipulated to create a false impression of the company's financial position. And this, by now we end the revision of business finance 2. Hope all you are in good and health and in safe. Thank you for listening, and wish you a good luck in the exams, inshallah. Thank you. Bye bye.